Stock market weekly chart review for the week of September 19th through September 23. Things change in the stock market. Things change in where you gather information from. So for example, remember for X amount of weeks, the screener for Fidelity.com, it was giving us the sector breakdown, but it's not giving us that anymore. It's got the top holdings. It's got, let's see, it's got a place to log in now, regional exposure, county exposure. But with this strategy, we're looking up different ETFs that correlate with different sectors. So when things change, right, we change. It just happens to be that finance.yahoo.com has, under the S&P 500, holdings, sector weighting. Now, maybe the weightings have changed, or maybe Fidelity and Yahoo are, one of them is inaccurate, but we're just going to go with this. So we see technology is either it is reduced a bit to a little less than 25, or maybe Fidelity was wrong. I'm not going to go through and explain, this whole thing, but we see there's some discrepancies. We don't know where that discrepancy is, but still we got technology being the leader. And then from there, we got healthcare. And then, interestingly enough, we got financials, and then consumer cyclical, which Fidelity was calling consumer discretionary. Remember that from a few weeks ago? Fidelity had this financial, had real estate listed twice. So we're gonna stick with these, and it already happens to be that that in here the real estate ETF is in there, so we'll do that. And we have this XLK for technology, XLV for healthcare, XLY for consumer discretionary, XLRE for real estate, and XLF for the financials. We're going to move into that, and very quickly let's go through and take a look at this chart right here, this Pro 2, which is a long-term trend chart. Now you see these candles here, these are red or green based on where the open and the close was. So if the open was lower than the close, it's going to be green. If the open was higher than the close, or close lower than the open, it's going to be red. Up day is green, down day is red. But the color on this, even though these are daily candles, the color is not signified by the open and close. The color is a representation of how much institutional money is flowing in or flowing out of a stock via selling and buying of stock. So S&P 500, we see for 2 getting close to 3 weeks, money's been flowing out. This is a weekly stochastic, and you see the red line is under the yellow. It means moving down, and you see we have a pretty wide gap between these two red lines. This week, these stochastics are lagging indicators. So this is lagging, but it's lagging on a big time frame. So it's really showing us the downward trend is still going down. Technology, look at that, huge downtrend on the stochastic. Really wide gap there. But notice we are getting to this oversold line. It doesn't mean it can't keep going lower. See down here, it was way under that, but it just gives you a quick outlook of a trend. Money's still flowing out. Healthcare. Now money's been flowing into healthcare, and the stochastic, see how it's just kind of been moving sideways. So even though there's enough money flowing in, there's enough institutional buying going on to trigger this indicator to turn green, it's not having this dramatic uptick in the stock prices. Well, that could be because the whole market's in a downtrend. Who knows for sure? Consumer discretionary, we see the same thing going on. kind of bit of this sideways stochastic. It started kind of getting up there, but going down, and we've had the money flowing in for a while. Real estate, money has been flowing out. You see that stochastic just been trending down, starting to go below that I think this is at like the 30 or 33% line, something like that. Financials, money started flowing in a little bit, but just started flowing out. Now, interestingly enough, see this yellow? The yellow is there when there's not enough to be one or the other. Right from here, it was red, it goes to yellow because there's not enough money flowing out to be red, but there's not enough money flowing in to be green. So interestingly, it just switched from red to green and then back. Stochastic moving down. Now let's look at our weekly chart for we'll look at the S&P 500 first. We got the 2-year weekly chart, so each one of these candles representing 1 week of time. We see this week lots of selling volume coming in. The volume is high, getting close to that 200-day moving average. We're getting stuck right here in this kind of resistance. We'll have to see this week. I wouldn't be surprised if we at least touch this 375 point. But we drop below last week's candle. We see that the trading range, it tried to get up here, tried to get into this 390 range, but sellers just push it all the way down here. So we're down here. We look to the left. Is there anything? Not a surprise, right? Kind of congestion of prices right there. XLK technology, right? Again, 2 weeks in a row, a pretty heavy selling volume, getting close to that 200-day moving average, and we see less wide of a body, wide trading range, and the body of it though looking pretty bearish, because see how this wick part is longer than this, so prices traded relatively high up there, but opened here, closed down here. We see getting stuck in this range. Look to the left, you know, sort of there. It's not as clear as some other things, but I have to wait and see what's going on for that. Healthcare, last week we had a really uptick in the volume of selling. Here is a bit, you know, here's where we can see some of that buying that we saw in the Pro 2, the money flowing in. So here we have the open here, barely traded up any higher though, just a tad bit, and traded all the way down here, but buying pressure pushed it up here. Looking to the left, we see it kind of stuck in this range. Keep going to the left, and we see some price consolidation here. Now we're a bit closer to that 50-day moving average than we are that 200-day moving average. So we'll see. Maybe healthcare will kind of keep going sideways while everything else is moving down. Consumer discretionary, a little less volume than the week before, but overall, you see we're kind of at a little bit of elevated volume. Big, wide body candle coming down here, really hitting that 200-day moving average. Traded below it, but just closed right above that 200-day moving average. So we'll see, is it really going to crash through the 200-day moving average? I think it was money flowing in, but it doesn't seem to be helping too much besides that. Maybe the money flowing in will keep it right around that 200-day moving average. We'll see. But if it crashes below the 200-day moving average, money will probably start flowing out. Real estate broke below the 200-day moving average, and pretty big, significant increase in the amount of volume. And looking to the left, we're kind of hitting this price consolidation from over here, and looks like price is just going to keep dropping. Financials, XLF, volume just a little bit down than last week, but we still got this elevated volume when we see the averages in here. Really high amounts of volume of selling coming in, and we see touch that 200-day moving average with just had some buying come in and press that up, or kind of getting stuck here in this price consolidation. So what do we think is going to happen with the S&P 500? Here's another chart on Yahoo. This is going back, goes all the way back here to, looks like 1993, and it's showing, it's obviously a line candle, but it's on a weekly interval. So right now we're right there, right? So Where is it? Come on, come on, come down for me. It's not coming down for me. What is that spot? Okay, so we want to be looking around this 365. That was, see that last low down there? See that right there? If it breaks this 365, or what was that 365? Yeah, roughly right around in there, 365. Here's another little point that if it breaks 365, we might see it go down to the 330 range. Is that right in there, somewhere in there, 330 range? And if it breaks through that, we might be looking all the way down here. I mean, that's a really, really far drop. We'll see what the powers that be. I mean, there's a certain amount of trading that's going on, and there's a certain amount of financial market rigging that's going on by different entities. And if it's in their best interest to let things drop, they'll let it drop. If it's in their best interest to hold up, they'll try to hold it up. So overall, we're still in a down market. And so my prediction is we're probably going to be, I think all I really want to go out on a limb and test to say maybe we're gonna test this 357. Maybe we'll hit the 200-day moving average. But if we're really breaking that, when we're looking here, if it breaks around this area, 365, 57, somewhere in there, we could be dropping, you know, down here. And it would be interesting if we get a drop all the way back down to here. So in the meantime, if you haven't already, go to eyeofsuccess.com, download one or all of these PDFs, whatever is useful to you. I'll send you every day the market's open. I'll be sending you market commentary and the advice. Now, I'm not a financial advisor, so this is not trading advice. This is not financial advice, but I will go out on a limb and potentially take a risk and give you a piece of advice. And that advice is, if you don't already have a paper traded simulated trading account, get one. Because the market right now, if you only know how to make money in an upward market, you're really handicapped. We're in a bear market right now. It's a pretty volatile market. So open a paper trading account. Do anything you want. Every single strategy you could ever think of, try it in your paper trading account. See what happens. Learn as much as you can possibly learn while we're in a bear market. Because, you know, they say the bull goes up the stairs and the bear goes out the window. So it drops quickly, but it usually doesn't drop as long. And, you know, maybe we're going to be in a different dynamic. Maybe we're going to be in a bear market for, I don't know. I heard someone talking about it could be like a cyclical change in the stock market. So maybe we could be in like a 10-year bear market. Maybe not. But either way, why not be prepared? If it's going to be a short bear market, learn as much about trading in a bear market as you can. If we're going to be in a bear market for a long time, quickly learn how to make money in it so you can make money no matter how long it lasts. You guys have a fantastic night, and I'll talk to you later. Bye-bye.